Hey everyone, and welcome to this explainer. Today, we're putting on our professional sell-side equity analyst hats to do a ruthless, rigorous breakdown of the fundamental intrinsic value of CSTM. We are going to strictly use their latest financial data, stripping away all the market noise to see what the numbers actually say. No hype, no rumors, just pure, unadulterated, fundamental analysis.
All right, let's dive right in. Here's the game plan for our valuation report today. First, we'll unpack the performance paradox, then evaluate relative valuation multiples, move into absolute valuation models, address our data limitations, and finally, deliver the intrinsic value verdict.
Section 1, the CSTM performance paradox. You know, we really have to kick things off by talking about the staggering market illusion currently surrounding CSTM stock.
Just look at this number. 274.9%. I mean, wow. That is the total return compound annual growth rate for the trailing 12 months. If you're a momentum trader, a number like that is an absolute dream, right? It creates this incredibly seductive surface-level illusion of massive sustainable growth. It's exactly the kind of figure that drives intense market FOMO, pushing the current price up to nearly $33 a share.
And this data brilliantly captures the absolute whiplash we're dealing with. We aren't looking at a smooth, steady climb here. We're seeing wild, volatile swings from a massive, gut-wrenching drop of almost 49% in 2024 to an explosive surge of over 83% in 2025, followed by another nearly 75% jump year-to-date. As analysts, we have to ask ourselves, is this erratic price action actually supported by the underlying business operations? Let's find out. Moving on to Section 2, relative valuation multiples. Let's look past the momentum and see if we can justify this wild price action by comparing the company's current valuation to its own historical norms. Stepping past the hype, we gotta look at the cold hard multiples. Based strictly on the filings, CSTM is trading at significant premiums across the board compared to its own historical averages. Look at the enterprise value to EBITDA ratio. It's currently sitting at 7.83. That's a 34% premium over its trailing 12-month average. EV to sales is up 48%, and the price-to-earnings ratio is stretched to 17.08, up 36%. The market is clearly paying a hefty premium for CSTM's earnings today compared to just a few months ago. But, here is where we hit a bit of a brick wall in our relative valuation. To complete a true peer comparison, we desperately need a defined peer group, which is notably entirely missing from the source documents. So to compute a target implied value, we'd have to declare an external assumption. Because specific comparable companies aren't listed, we would need to manually select a peer group based on CSTM's incredibly thin 1.69% net profit margin. Without making big, unverified assumptions about exactly which low-margin industrial peers to use, our strict adherence to the data means we just cannot confidently compute a relative implied share price.
So let's look elsewhere. Section 3, absolute valuation models. Time to strip away market sentiment completely and uncover the pure intrinsic value through cash flows.
This is where reality bites hard. Look at this massive disconnect. The stock is out there trading at $32.96, but our discounted cash flow model tells a completely different story, pinning the intrinsic fair value at just $9.24 per share. Let me walk you through exactly how the math forces our hand to this number. To derive that $9.24, we follow a rigorous step-by-step discounted cash flow methodology. First, we take the reported trailing 12-month free cash flow, which sits at $159 million. Next, we have to heavily discount those future cash flows. Why? Because the company has a really high debt-to-equity ratio of 2.04, which drives up the weighted average cost of capital. Finally, when we build our explicit forecast, we have to use the company's historical 5-year free cash flow compound annual growth rate, which is a microscopic 0.90%. When you project less than 1% cash flow growth and punish it heavily due to debt risk, bam, you land squarely at a $9 valuation. Now you might be thinking, hey, what about the dividend discount model? Well, actually, scratch that. As rigorous analysts, we've got to skip the DDM entirely. The data explicitly shows a 0% dividend growth rate and a complete lack of a consistent dividend policy. Without reliable dividends to forecast, a multi-stage DDM is just mathematically void for CSTM. Section 4, addressing data limitations. Because honestly, in fundamental valuation, what we cannot model is just as crucial as what we can. Normally, a sum of the parts model, or SOTP, would be awesome here. This method involves valuing a company by independently assessing each distinct business segment and then summing up their equity values. It's like a giant puzzle. We use this to see if hidden value exists in separate divisions that the overall market might be ignoring. But let's look at why we can't pull that off for CSTM.
The provided documents entirely lack the required segment-by-segment risk profiles, revenue breakdowns, and explicit asset line items. I mean, without knowing how much cash each specific division is generating, an SOTP analysis or even a net asset value restatement is simply impossible based strictly on the provided filings.
Let's break this down a bit further. SOTP is out because of the missing segment data. Asset-based liquidation? That's out because we can't restate the balance sheet to fair market values without some heavy external guesswork. And what about adjusted present value, or APV? Well, given the company's high debt-to-equity ratio of 2.04, APV is highly applicable in theory, since it separates the value of operations from the value of debt tax shields. But to execute it accurately, we need explicit side effect tax shield data, which our source material just doesn't provide. Ultimately, forcing any of these models would require unverified assumptions that violate the strict boundaries of our evidence-based approach.
Which brings us to Section 5, the intrinsic value verdict. Let's pull the whole shebang together, all these models, metrics, and limitations, to reach our final analyst verdict. Brace yourselves because this number is just jarring. Negative 256.73%. That right there is our calculated margin of safety. In value investing, you always want a positive margin of safety, meaning you're buying the stock for less than its actual intrinsic value. Here, we have a terrifyingly negative margin. It's driven by a sky-high trading price that has become completely decoupled from our base case DCF fair value of only $9.24. The cash flows simply do not support the current nearly $33 price tag.
So I'm going to leave you with this provocative thought to ponder. Based strictly on the financial filings, the fundamentals flash deep, dark red. The margins are incredibly thin, the debt is sky-high, and the free cash flow growth is basically flat. Yet somehow, the momentum has pushed the stock up almost 275% in just a year. So what exactly is the market seeing that the math isn't? Is there some invisible, unannounced catalyst on the horizon, or is CSTM simply a momentum trap bound for a massive fundamental correction? Thank you for joining me on this rigorous look at the data. Keep questioning the numbers, and I'll see you in the next explainer.